Is shadow inventory finally starting to show up in the housing market? Folks, at the end of the day, we've had lots of people talk about shadow inventory. In fact, I believe one of the past years, shadow inventory was the reason for the crash. The reason for the crash is ever changing. But let's talk about what's really happening, what is important to you, and is this a trend that will ultimately lead to price drops? So I want to give a shout out where shout out is due. This particular report or headline came from someone I follow called Wolf Street. Wolf Street, I would say, generally leans negative. Yes, I consume information on both sides as I look for blind spots. I look for early indications. And frankly, I learn messaging. So again, what was this article talking about? Basically, what we are seeing in some parts of the country is active inventory build. Frankly, again, that is a good thing. I believe at the national level, we are up about 30, maybe 32% from a year ago. Again, not yet back to kind of pre-pandemic levels on a national level, but there are certainly some markets that are particularly vulnerable. What we have been talking about for the last year or so, maybe 18 months, is two states are seeing a majority of this growth. Now, in this article by Wolf Street talking about shadow inventory exploding higher, yes, vacant homes are piling up. This is according to them. They are generally referring to Texas. Yes, Wolf Street. That is who I'm referring to, Chester. Wolf Street is saying that in Texas, new listings spiked 22%, not in a year, in a month. Folks, that is significant. Anytime you could see a market, a city, a state, frankly, your buy box move by 22% in a 30-day window, that is significant. In fact, they said there are now 45,004 homes. That is up 26% year on year. But again, what is important for us to look at is the change month on month. And again, that was reported as 22%. They highlight that Austin specifically was up 17% month on month, 22% year on year. Houston, 16% month on month, 12% year on year. In fact, the article went to highlight the top 10 markets that saw a change in a month. And guess what, folks? You're either in Texas or Florida. The story hasn't changed. If you want to create a negative housing story, you take Texas or Florida data and suddenly make it appear like national information. That is the latest trick of the doomers. However, what should you and I do with this information? Well, number one, if you follow my channel and you're doing what we talk about, you have what's called a buy box. You have a set of criteria that produces a list of active listings. I suggest, as Wolf Street points out, you should be tracking that. And you should understand what is going on in your market. So, for example, if you're doing what I ask, how much inventory do you have today? And how much inventory did you have last month? Is it up 20%? Is it up 40%? Is it flat? Is it down? These are the information that you should follow. Most of you should care zero about national numbers. Most of you should care zero about state data. Most of you should care zero about city level. You should care about your buy box. You should care about dominating your buy box. You should understand what's going on in your area. And yes, one of those variables is active inventory growing. Is it growing quickly? Why is that important? Well, it's important because it highlights to you the market is changing. One of the reasons I want you to look at your buy box each and every day is to see if the market is changing. If inventory is stacking up, as Wolf Street highlights in some Texas and Florida markets, you should know that. That's good information. And again, what you do with that information is, of course, powerful. Is it a highlight that maybe you should write offers lower because inventory is growing? Are you seeing an acceleration of pending? Are you seeing price drops? Are you seeing back on market? What are you seeing in your buy box? Folks, this is the power of one rental at a time. Focus, daily discipline, consistency. It is not sexy, but it will make you rich. If you want to get rich, you got to do what others are unwilling or unable to do. Focus, daily discipline, and consistency. I want to shout out 2 people for joining school in the last 48 hours. Shout out Brian, and I'm going to say Kith. Hopefully I'm somewhat close on that. For joining school. Folks, I really don't know why you're not in school. It's 67 pennies a day. We talk about all this stuff. In fact, I go live again on Sunday morning at 8 a.m. If you've ever wanted to ask me a question, you want to talk shop, I will be going live in school at 8 a.m. Pacific. In fact, I will put the link after this is over. I haven't done that yet, so I'll do that momentarily. But again, folks, remember the doomers, their job is to scare you. It's to take regional or state or city facts and make it seem bigger than it is. So how do you counteract that? Simply do the work and know your stuff. Let's talk about things to watch in 2025. We are going through some, one might say, uncertain times, once in a lifetime, whatever you want to call it. So I just want to highlight for you the things that are important, in my opinion, that we've learned over the last week that, frankly, maybe I didn't look at in the past. And number one, this is apparently really going on. We are having foreign countries, friends and foes, change allocations. Maybe historically they allocated, I don't know, I'm going to make up a number, 80% of their invested capital in U.S. assets. That now is clearly going down. I believe it's going down in the majority, if not all, foreign countries, friend and foe. The question that we must figure out is how much. If the blended average, again, we'll just pick a number, is 70%, because, again, we are the biggest country, we're the most liquid, the rule of law, all the things that you and I have heard about for decades. That is now all in flux. We have inadvertently, perhaps, tipped over the apple cart. And now instead of investing 70% blended average, it's going lower. The question is it 65, 60, 55, 50? It is going to be different. And that is going to be significant. It is going to hurt. As we talked about yesterday, that might impact the rates on 10 years. If there are less buyers, and there are more sellers, guess what happens to supply? It goes up. Guess what happens to price? It goes down. Guess what happens to rates? It goes up. Now, yesterday we talked about the potential for having the 10-year at 6%. Lots of you thought that was crazy talk. I will admit I did not have that on my bingo card. But I have to tell you, in my opinion, a 6% 10-year is a non-zero chance. It's not zero. It might be 8, might be single digits, might be 12%, might kind of in that range, but it's non-zero. Josh, I want to thank you for the super chat. Let's, I think I can highlight these things. Oh, look at that. Josh, you're amazing, man. Thanks for the super chat. I think that's what that's called. Hit the like button, folks. Appreciate you. So what else? The 10-year. This has always been important, but most of the time you and I could look once a week and we'd figure out what's going on. I think it's important to watch it. I'm actually watching the 10-year. I check it at night, which I've never done before, right after hours, see if anything's going on in Asia markets. I check it in the morning, see if there's any delta. Again, these are important things. Inflation expectations. Again, this is quote unquote soft data, but we have seen an extreme move in this data. So we have to see if it reverses or gets worse. It's not so much about the number, it's about the trend, because inflation expectations can change behavior. And we'll see that in a minute in retail sales. Watch the unemployment rate, right? That's pretty much the only thing, in my opinion, that's going to get the Fed's attention. If you're hoping for a Fed rate cut in 2025, you are also likely hoping for unemployment to go up higher. The Fed cannot be cutting when inflation expectations are 5%. That's just not going to happen unless the unemployment number breaks. And then I think it's going to be important to watch GDP in Q2 and Q3. Again, I think anything that happened in Q1 today is irrelevant. Yes, it's hard data, but it's hard data that means absolutely nothing. Liberation Day, the day that changed everything, the day the apple cart was tipped over was April 2nd, second day of Q1, or Q2, sorry, second day of Q2. So again, Q1 doesn't matter. The world has changed. So anything that comes out with Q1 data to me is not important. To that end, let's talk retail sales. Retail sales in February were reported at 0.2%. The estimate going into today was it was going to grow significantly. It was going to grow at 1.2%. Reality, 1.4. As we talked about earlier in the week, I suspected this number would be good because of auto sales. So with retail sales, they do a report X autos. So I got those numbers as well. X autos, because that's a big ticket item in retail sales, obviously, was estimated to be up 0.3. In reality, it was up 0.5 X auto. So again, folks, we have soft data saying the consumer is scared, this, that, the other, but then we have hard data that they are still spending and spending more and more. I would argue that a lot of this was pre-tariff buying. Again, we've already saw autos were significant. Think furniture, think these other things. I know of a lot of people that made significant purchases. In fact, Olivia and I bought something that was crazy expensive pre-tariff as well. So again, changes consumer behavior. Q1 GDP is likely going to be positive because, again, pre-Liberation Day. It'll be interesting to see what Q2 has to say. Back to my point earlier in the week about auto sales. I don't know if you guys realize this, but the buying in autos is off the charts. But be careful. There is this notion of pull forward demand. It's where you take an activity that you normally would have done later, think May or June, and you do it now. Why is that important? Well, that demand gets pulled forward and then it's not backfilled. So we seem to be pulling forward demand for automobiles at a lightning speed. Why do I know that? According to Cox Automotive, days of supply for vehicles was 91 last month. We have been so busy buying autos that days on market this month are 70. Days on market for automobiles does not drop 21 days in a normal month. This is clearly tariff behavior. People buying before going to be expensive. And again, that data will roll through in Q1 and in Q2. So yes, days of supply of cars is like days of market on homes. Absolutely. Let's talk about some earnings that came out. Albertsons, obviously a grocery store, if you don't know. They came out and beat top line, beat bottom line, but gave weak guidance. Says that inflation is still hurting the consumers. PNC Bank, they increased their provision for bad debt. JB Hunt, if you don't know who JB Hunt is, it's in the transportation space, says that ongoing weakness across all sectors of their business. I can't imagine folks in the transportation business are going to have a very good Q2 if deliveries from China fall off a cliff. We are still seeing a trade war escalate. Yesterday, we talked about rare earths coming from China being nixed. Now you have China canceling Boeing orders. Not to be outdone, President Trump hit back at China and said, "Thou shalt not have NVIDIA chips, H20 chips." They already can't buy H100s and H200s. Now they said you can't have H20. This is such a big deal to NVIDIA that they announced a $5.5 billion write-down in the quarter. This is essentially becoming a blockade. We are seeing companies like AMD and others be drawn into the fire. United Airlines, again, reported some decent numbers, but we are starting to see a theme, folks. They actually did something quite unique, but they basically are cutting flights because domestic demand is falling. Remember, folks, we talked about something that is likely coming is a lot of companies are going to pull guidance. You remember that? United did something pretty cool. They basically said, hey, here's one forecast if there's a recession, and hey, here's another forecast if there is no recession. I do not suspect most companies will do that. I suspect most companies will start to pull guidance. We start to get really meaty earnings starting next week. A lot of the earnings thus far have been very banking oriented, with a couple of United and Delta thrown in for good measure. What else do we got? Let's talk about. Oh, I got one. Yesterday was tax day. Some people that I talk to in my life are excited to get a tax refund. Michael, I got a $2,000 tax refund. I got a $2,800 tax refund, whatever it is. Great. If you're happy, I'm happy. But I do want to remind you of one sad fact. If you got a $3,000 tax refund, that means you gave a loan to the federal government of $3,000 at 0% interest. That's what that means, right? You paid more than you should have, and they're giving it back to you with 0 interest. So again, I'm not opposed to being excited. I'm not opposed to using that as some forced savings or something, but just remember what you are excited about. We did see a note. I don't know if it's going to mean anything, but apparently China is open to talks if Trump shows respect and names a point person. Okay. Jim Bianco is out talking about a lost decade. I think we are seeing more and more people talk about that. Again, with stagflation, more talk of the 70s. Folks, if you haven't gotten the free 54-year spreadsheet off my website, One Rental at a Time, I don't know what you're talking about. Go to onerentalatatime.com. There's a little button that says, I think it says 53-year spreadsheet. Put your email there, and it will auto send you the file. You can go through 15, 20 different metrics across the 70s and see what happened in a lost decade. Last thing we'll talk about as we go through this is the Empire State Manufacturing Survey. Basically what's going on in the New York area around manufacturing. Again, last month was a horrible number at -20. It was expected to be a little bit less negative at -12. It came in at -8. So again, better than expected, but still contracting. So folks, again, remember, please join school. We've got people posting nearly every day about wins. We got people asking questions. We got masterminds. We got thousands and thousands of dollars in free education, all for 67 pennies a day. Go to school.com. That's with a K, SKOOL. Look up One Rental at a Time. And I look forward to seeing you there. And again, remember, you can try a month at a time, just $20. And I will be going live this Sunday at 8 a.m. I hope you have an amazing day. Like, subscribe, comment. Just be good people. Just have a good day. Later.